The clarity trap is already set. The Senate finalized the language. The headlines called it a win for digital assets. But here is what the clearinghouses didn't announce, and what nobody tracking retail news cycles is reading. The Clarity Act does not open XRP's institutional settlement corridor immediately. It creates a compliance perimeter. And inside that perimeter, Tier 1 liquidity providers are waiting on one specific document before they route capital. That document isn't a court ruling, it isn't a price chart, it is an internal risk model filed quietly with the DTCC that determines whether distributed ledger assets qualify for operational clearing. Here is the part they aren't telling you. The Senate vote is a structural prerequisite, not a trigger. The trigger is something else entirely. Most retail holders are tracking the vote count and the legislative timeline. They aren't tracking the clearinghouse risk model filing cycle. That asymmetry is exactly what this audit is exposing today. Let's break down what the Clarity Act language means at the institutional plumbing level, not what the headline said, what the ledger data is actually telling us. The Clarity Act, in its finalized Senate form, establishes a definitional framework. It separates digital commodities from digital securities at the legislative layer. For XRP specifically, this matters because Ripple's partial litigation resolution created a structural ambiguity. The asset occupies a classification gray zone depending on the transaction type. The Clarity Act collapses that ambiguity. But collapsing legal ambiguity is not the same as opening the liquidity corridor. Here is what happens next at the institutional plumbing level. Once the definitional framework is locked, custodial banks must file updated internal risk classifications with their primary regulators. That filing window runs between 60 and 90 days post enactment. During that window, no Tier 1 liquidity provider can route institutional grade capital through an asset that hasn't cleared their internal compliance perimeter. That's not a guess. That's how the ledger is coded. The DTCC's operational clearing loop requires a clean risk classification at the custodial layer before settlement velocity can expand. Without that classification, XRP's order book compression continues, regardless of what the Senate voted. Look at the numbers. The average institutional compliance filing cycle runs 74 days from legislative trigger to operational clearance. During those 74 days, the asset trades purely on retail sentiment and short-term speculative positioning. That's exactly the window that creates the volatility trap. Retail sees the headline, buys the narrative, and expects velocity expansion. Institutional liquidity providers are watching the compliance clock. Those two timelines are not synchronized. That structural clearinghouse friction is what the Clarity Act vote just activated. Now let's go deeper into what this means for XRP's specific settlement rail architecture. Ripple's ODL, on-demand liquidity, routes cross-border transactions through XRP as a bridge asset. For that corridor to scale at institutional volume, the counterparties on both ends need clean custodial classifications. The Clarity Act provides the legislative foundation. Foundation is an infrastructure. The next layer is the Bank Secrecy Act compliance update. Custodial banks must align their AML frameworks to the new definitional structure. That alignment requires a secondary filing with FinCEN. Most retail analysis completely skips this step. They see Clarity Act finalized and assume the corridor is open. The corridor isn't open until the FinCEN alignment is filed and acknowledged. That process runs parallel to the DTCC risk model filing, and the two clocks don't always clear at the same time. Here is what that means in practice. If the DTCC risk model clears at day 74, but the FinCEN alignment is still processing, XRP's ODL institutional volume cannot scale. The corridor is half open, and a half-open corridor is operationally the same as a closed one for Tier 1 liquidity providers. They won't route capital through a partially compliant rail. The liability exposure is too concentrated. So the question isn't whether the Clarity Act is structurally positive for XRP. It is. The question is, how many parallel compliance filing cycles have to resolve before institutional capital actually moves? Based on the current regulatory architecture, the realistic institutional activation window runs 90 to 120 days post enactment. That's the institutional plumbing reality. Now let's look at what this means for the broader tokenization timeline. The Clarity Act's passage accelerates one specific institutional process. It gives asset managers a clean definitional framework to classify tokenized assets on their balance sheets. BlackRock, Fidelity, and the major custodial networks have been running parallel tokenization pilots. Those pilots have been operationally stalled at the definitional layer, not technically. The distributed ledger systems are functional, the stall is legislative. The Clarity Act clears that stall, which means the tokenization pipeline, which has been building pressure behind a definitional dam, can now begin to flow. Here is the part they aren't telling you about what flows first. The first assets to move through that cleared pipeline won't be XRP. They'll be tokenized treasury instruments and money market fund shares. Those asset classes carry the cleanest balance sheet classification and the lowest regulatory friction at the custodial layer. XRP enters the institutional tokenization corridor only after custodial banks have stress tested the pipeline with lower friction asset classes. That's how clearinghouse risk models sequence new asset onboarding: conservative to aggressive, low friction to high friction. Here is the critical layer that most audits stop before reaching. And this is the part that actually determines whether XRP's velocity expansion happens this year or gets pushed into the next window. It comes down to one specific Basel III compliance parameter. Basel III requires that custodial banks hold capital reserves against digital asset exposure. The reserve ratio for unclassified digital assets currently runs at 1,250% risk weight CU, meaning for every dollar of XRP exposure, a bank must hold $12.50 in reserve capital. The Clarity Act's definitional clarity positions that risk weight classification for reduction. But the Basel Committee doesn't automatically adopt U.S. legislative definitional frameworks. They run their own independent classification process. And the Basel Committee's Digital Asset Working Group is operating on a timeline completely separate from the U.S. Senate. If the Basel risk weight reduction doesn't sync with the Clarity Act domestic timeline, international custodial banks, specifically those operating under European and Asian regulatory frameworks, cannot reduce their reserve exposure. That means the institutional capital that retail is expecting to flow into XRP's corridor may be domestically unlocked but internationally frozen. That's the clarity trap in its clearest structural form. Domestically cleared, internationally constrained. Here is the tactical read for what to actually track over the next 90 days. Watch the DTCC's public filing register for any updated digital asset operational clearing framework documentation. Watch FinCEN's regulatory update feed for AML alignment acknowledgement notices tied to the new definitional framework. Watch the Basel Committee's Digital Asset Working Group publication schedule for any reserve weight reclassification announcements. Those 3 data streams will tell you more about XRP's institutional activation timeline than every Senate headline combined. The vote happened. The compliance clock is running. The corridor opens when all 3 filings clear, not when the Senate adjourned. Audit the plumbing, not the headlines. To track exactly which compliance filing resolves first and what it means for the institutional activation window, click the related video link right now.